Hey guys, and welcome back to another video. In today's video, as you can tell by the title, we're going to be talking about how the stock market generally performs in a presidential election year. Make sure to stay tuned, however, because this might not affect the market as much as you might think, but we'll get into that towards the end of the video. We are going to dive straight into the data, into the reason why you clicked this video, and that is to understand how this year might be a little bit different from previous years in terms of the stock market. And I think that this graph right here does a fantastic job at demonstrating these trends. With these years that are a little bit different than non-election years, you can see that it's important to break it up into two sections. Number one being the months that involve primaries, which is normally about the first 5 months of the year, as well as after primaries, which is obviously the rest of the year. Generally, we're going to see great gains coming during these first 5 months, particularly with the non-election years, but we see that that is super different with this presidential election, and oftentimes, at least in terms of the average returns, we're going to see negative returns during those first 5 months. This is likely just due to the uncertainty and the sort of weariness of people with so much potential change coming towards the end of the year. You can see that after the primaries are over, however, this is a totally different story, and generally in the election years, the stock market rebounds quite well and ends up doing just about as well as the general market on these non-election years. Obviously, things are different every year with different circumstances, but it may be a good idea if these trends continue to wait until a little bit later in the year, maybe closer to May, to consider investing back into the stock market if you have a little bit of money waiting around that you're wanting to invest. Now let's go ahead and have a look at a graph that gives us a little bit of a different perspective and specifically shows us the situation that we're in this year, having a Democratic president in the 4th year of his office. We see many of the same trends in this graph, however. You can see with this purple bar, which represents all of the years instead of just these presidential election years, it's a little bit more positive towards the beginning of the year compared to our election years. Both general presidents in their 4th year and Democratic presidents in their 4th year have these negative months in February, a little low in May, and then towards the end of the year in November and in December, we see an uptick as a lot of that uncertainty has gone away and people know what is going to be going on for the following 4 years. One thing that's important to keep in mind, even though this data comes all the way from 1950, we're only taking every 4 years for a lot of these data sets, and in terms of the Democratic president in year 4, that's an even smaller data set, meaning that although this might show us the trends, things could be very different this year for the better or for the worse. Staying with that trend of having a little bit of a problem with this small quantity data set, I think it's important that we have a look at this chart as well as one more chart that shows us some of the factors that might be even more important than an election year in terms of predicting stock market performance. I'll let you go ahead and have a look at this chart on your own. There's no real reason for me to read all of the numbers to you, but the real important thing is this bar on the far right, showing us whether or not these statistics are statistically significant, meaning are they valuable and real statistics. You might notice that over half of them say no, meaning that this might not be the best indicator of market performance, and rather we might want to look at some other things that are statistically significant to help us decide how the stock market might do this year in 2024. And that is where this chart right here is going to come in and help us. You can see that all of these are statistically significant, meaning that they're valuable and they might provide us a little bit of insight on the stock market's future. Now this is a super easy graph to read. On the left here we have some of our economic indicators, whether there's rising or falling growth in the economy and whether there's rising or falling inflation in the economy. I'm sure if you're watching these videos by now you understand if the economy is growing, that's a good thing for the stock market, And if inflation is falling, that is also a good thing for the stock market in terms of its future potential performance. Once again, I'm not going to read all of these numbers to you. You can pause the video if you want to have a closer look at them, but we see this general trend once again with the average 3-month return relative to all periods being much higher for the rising growth and the falling inflation groups. I hope you did go on to enjoy today's video, and I hope it gave you a little bit of a different perspective on what the stock market might look like in this election year. If you have any questions or comments, leave them down below. Make sure they're civil, and leave a like while you're down there. But other than that, we'll see you in the next one.